Hello everyone. Welcome to this presentation on optimizing capital budget, financial sources, instruments and markets. I am Rifat Kubi Sharna and today I will walk you through how publicly traded companies systematically allocate resources, identify financial sources and uses and optimize their capital budgets using financial instruments and markets. Let's begin. First of all, capital budgeting is a structured process used by companies to evaluate potential long-term investments, such as expanding operations, launching new products, or acquiring assets. For publicly traded companies, access to a variety of financial instruments and markets allows them to optimize their resources effectively. This process is essential for informed managerial decisions that balance risk and profitability while ensuring sustainable growth. Next, we will focus on the critical elements of capital budgeting. First, let's discuss financial sources. Identifying the right mix of sources ensures that projects are funded efficiently without straining the company's financial health. Next, financial uses refer to how these funds are allocated. Companies typically direct these resources towards investments in new facilities, technology upgrades, or product development. Proper allocation of funds is key to maximizing returns and achieving strategic goals. Another essential component is the use of budgeting tools. Techniques like payback period, net present value, and internal rate of return are employed to evaluate potential projects. These tools provide a framework for assessing risk, profitability, and liquidity, ensuring that managers have a clear understanding of a project's viability. Now, companies have three primary financial sources: debt financing, equity financing, and internal funds. Debt financing involves borrowing through bonds or loans. Equity financing comes from issuing stocks, and internal funds rely on retained earnings or operational cash flows. These funds are allocated toward expanding capacity, introducing new technology, or enhancing operational efficiencies. Aligning these sources and uses is critical for effective resource management. Next, the payback period measures how quickly a project can recover its initial investment. It is particularly useful for assessing liquidity and short-term risk. While it is easy to calculate and understand, the payback period does not account for the time value of money or profitability beyond the recovery point. Despite its limitations, it remains a valuable tool for comparing projects with similar timelines. Next, net present value calculates the net difference between cash inflows and outflows, considering the time value of money. It is a reliable matrix for evaluating long-term profitability. A project with an NPV greater than 0 is financially viable, while a negative NPV indicates potential losses. This method ensures that all cash flows are accounted for, but it requires accurate estimations for future cash flows and discount rates. Now, the internal rate of return is the discount rate at which the NPV of a project becomes 0. It indicates the expected annual return on investment. If the IRR exceeds the weighted average cost of capital, the project is considered profitable. While IRR is easy to interpret, it may produce conflicting results when comparing mutually exclusive projects or assuming reinvestment at IRR rates. Next, capital structure refers to the mix of debt and equity financing a company employs. Debt financing offers tax advantages but increases financial risk, while equity financing provides stability at the expense of diluting ownership. Finding the right balance between these components is essential for reducing the cost of capital and maintaining financial flexibility. Weighted average cost of capital, or WACC, represents the average cost of a company's funding sources and serves as a benchmark for evaluating investments. It is calculated as WACC equal to E divided by V multiplied by RE plus D divided by V multiplied by RD and 1 minus TC. Here, E is the market value of equity, D is the market value of debt, RE and RD are the cost of equity and debt respectively, and V is the total market value, and finally TC is the corporate tax rate. By minimizing WACC, companies can maximize their profitability. The optimal capital structure is the ideal balance between debt and equity that minimizes WACC while maximizing firm value. While debt financing is cheaper, excessive reliance increases financial risk. Equity financing, although more expensive, offers stability. Factors such as market conditions, interest rates, and the company's risk profile influence the optimal structure. The discussed elements, payback period, NPV, IRR, capital structures, WACC, and optimal capital structure, are interrelated and work together to inform capital budgeting decisions. Payback period addresses liquidity, NPV and IRR evaluate profitability, and WACC and capital structures optimize funding costs. Together, they enable managers to allocate resources strategically and achieve sustainable financial performance. To wrap up, capital budgeting is a strategic process that aligns investments with company objectives. By integrating tools like NPV, IRR, and WACC and balancing debt and equity through optimal capital structures, company can enhance decision making and achieve long-term growth. Understanding the interrelationships of these elements fosters better financial planning and resource optimization. Finally, this presentation is supported by authoritative sources, including the OpenStack Principles of Finance textbook and other valuable educational materials. So, thank you everyone for your attention and engagement throughout this presentation. I hope it has provided a clear understanding of capital budgeting and its critical role in corporate financial strategy.